In this video, I'm going to show you how you can make $10,000 a month or more and start your early retirement on the S&P 500 ETF or SPY. Don't worry about smashing the like button, subscribing, or looking for the Discord link or coaching just yet. I want to dive right into this and show you guys exactly how you can execute this plan so you can set yourself off to an early retirement. Let's get started. If you're looking to make more consistent income and you're looking to retire early so you can enjoy financial freedom as well as time freedom and location freedom, then you really want to make sure that you're not trading and investing in stocks that are highly volatile and going up and down a lot, or maybe they're hitting downtrends. And volatility is good for options premium when you're selling, but volatility is not good for options premium when you're buying. This is really not good for buyers. So I do a lot of strategies on buying shares, selling covered calls, selling puts, but that requires a lot of capital. So if you are looking to retire, don't have massive amounts of capital, then this strategy is for you. And if you do have $200,000, then this will just work even better. Because let's face it, if you're selling puts on the S&P 500, it's going to be over $50,000 per put. It's extremely expensive, and not everyone's going to be able to afford it. And to make $10,000 a month, you would need a lot, like $500,000. But there's another way to do this. And first, I want to explain to you guys why doing this on the S&P is actually a lot better and a lot safer than doing this on stocks such as Tesla. Sure, you can make a lot of money on Tesla, Meta, Google, Netflix. These stocks are all good for premium, especially selling puts, then getting into a stock, selling covered calls, which is the real strategy. Trading the SPY or the S&P 500 is safer because it's an ETF. It has the 500 top companies inside of this package, the S&P 500 ETF. So when you invest or trade the S&P 500, you're trading those 500 companies. When you trade Meta, Google, Netflix, Tesla, and the stock goes up, you make money. But if the stock goes down, you're losing money on your shares. You're also losing money on LEAP options or anything else that you've invested into that company, selling puts. Everything is going to be red if the stock goes down. However, there can be multiple stocks in the S&P 500 that are starting to go down, and it won't affect it as much as a single stock. For example, if Amazon is starting to go down on some bad news and you're investing in Amazon and you're losing money, the S&P 500 might not be going down at all. Apple might be in an uptrend, and a bunch of other stocks like Palantir might be in an uptrend as well. So basically you have the S&P 500 that's going up, yet Amazon is going down. It would take multiple companies having bad news to bring the S&P down, which is why it's consistently going up. And the S&P 500 has never had a downtrend. Only immediately after COVID, it hit a 6 to 8 month window where it was consolidating, going in a downward direction, and then consolidating, and then it came back up. But over the course of the last 20 years, there's been no downtrend, because remember, trends are things that happen consistently and continuously. And since it's an ETF and there's stock growth and it encompasses 500 of the biggest and best companies, which they also rebalance, the S&P 500 ETF is consistently in an uptrend. Sometimes this ETF will consolidate, sometimes it will pull back. And when it does this, it ultimately always recovers. In fact, the worst time for the S&P 500 was the 8 to 10 month window in 2021 going into 2022 after COVID. Outside of that window, the stock has consistently gone up, had a few pullbacks here and there, but it's consistently going up. This makes it a safer and better candidate to retire and run this strategy off of. I'm going to show you guys exactly how you can make $10,000 a month or more trading the S&P 500, but you don't even have to actually trade. You're just going to be enjoying financial freedom, enjoying your time away from the computer, while your trades are consistently printing for you. If you guys are confused by this strategy that I'm about to show you, and you don't quite understand it, the technicals, the fundamentals, the financials, the deltas, the things I'm about to explain to you, Don't worry, I offer full coaching, Discord, and training course to help guide you to understand strategies such as this even better and more clearly. You guys can sign up at investorcorey.com right there on the screen. The link is in the information box below. Before I show you guys these strategies, let's take a listen to what my student Adam has had to say about my coaching.
In just a short amount of time, the program that you offer, I've learned so much, and I've changed my entire approach to investing. You know, I'm much more structured, much more safe, and I've seen consistent, profitable growth. I've seen the growth, and it's almost like unbelievable. Like in a market that we're in now, I was still able to consistently grow because you're so, methodical and structured, and you care about each student. I'm here to say it how it is, right? I've made consistent growth. So I started with 15,000, right? I am now at $40,000. Okay. And I'm so proud. It feels, amazing to be able to share this, because I know that there's so many people that will do the same, right? You have to just trust Corey and trust what he's teaching and what he's offering, because he means so well.
So you guys have heard what Adam had to say, and you guys have seen the profits on the screen. I would love to help you. If you guys show up committed and ready to learn, I will show up committed, ready to teach you. And I look forward to seeing you whenever you're ready. So let's dive in. So let me show you guys how to run this strategy in your portfolio for you to consistently generate $10,000 a month. So looking at the SPY here, we're in the options chain. If we were to sell puts, you could sell them daily, weekly, bi-weekly, and you could also sell them monthly or even further out if you wish. However, this is a little bit different of a strategy because you don't need $50,000 to sell one put and make $50 or $100 a day. And what we're going to do in this video is, instead of buying, because this is a buying strategy, and I don't talk about buying strategies very often, but this is a buying strategy that works. Buying leap options. And what is a leap? Well, a leap option is a call option. You are right here clicking buy, clicking call, and you are buying a call option. But what makes it a leap option is that you're going out further in time. Now, technically, it should be 12 months or more, but I typically trade 6 to 8 months on the SPY. And the reason to do this is A, it's cheaper, and B, there's usually a lot more volume and open interest, which is a really good thing. However, when you go out further in time, it acts more like shares, and you have more time for the stock to appreciate in value. This way you make profits, which is good for stocks like Tesla, Meta, Google, Netflix. However, on the SPY, since it's an ETF and it's almost always going up with very small pullbacks here and there, it's more likely to appreciate in value quicker and more safely than a regular stock would. Therefore, you don't really need a year based on the history of the S&P 500. You really only need 3 to 6 months. So I typically do 6 months or so because it's safer. So let me show you exactly how to set up this strategy. You will want to look at buying a call option. And when you do this in the future, you want to go out at least 6 months, 4 to 6 months bare minimum, but I try to keep it to 6 months. Since we're doing this at the end of October 2024, we are going to be looking to go out to around April. So I'm going to look at April 17th or April 30th call options. Now, if you're wondering what strike price to pick, it's not as critical per se as on a stock, because if you buy a leap option on Tesla and you buy it, let's say at 240, and Tesla today is 250 or 260, Tesla could pull back in 6 months and drop all the way to $180 or $200. And then you're completely out of the money on your leap option. But if you buy a leap option on the S&P 500, the chances of it being lower 6 months from now than it is today is kind of on the lower side, like quite low. It's very low, honestly, especially if you're deeper in the money. So what we're going to do is we're going to look for a delta of around 70 or 75. You could go to 80 or 90, which is safer, but you're going to pay more premium for that. And what the delta is telling us is not only the percentage chance roughly of where the stock is going to end up. So if we were to look at, let's say, a 560 leap option, it's a delta of 70. This is not only a 70% chance that the stock will end up in the money, but more importantly, it's the equivalent of controlling 70 shares. That is what the delta of 70 means. If the S&P 500 was to go up by $10, this right here would turn to 0.051. which means this would go to a 75 delta. So if the S&P 500 went to 588, this delta would become 75. But this is just off of the first dollar. Every dollar this will change. So it's likely the delta will be pretty close to 580 if the price was to go to 588. So it's pretty safe to say that this delta would go to 80 if the S&P 500 went to 588. In fact, we could look at what the actual delta is of the option that is 540. So if we go down to the option that is 550, it's $10 below the 560 I was just showing you. If we do that, the delta should be pretty close to 80. We go to 550 and it's 75. So not quite 80. Probably have to go to 545 or 540. And 540 is just about an 80 delta. So the stock goes to 588. We're going to be looking at a 75 delta on the 560. So you can see that this is 45.30. If the ETF goes up by $10, which is very likely over the course of 3 to 6 months, it's probably going to move a lot more than that. But let's just say it only goes up $10, then this LEAP option is going to be worth $5,300 instead of the $4,500 we paid. So each LEAP option in 6 months or less is going to appreciate by $700 to $1,000 depending on the price. That doesn't include the covered calls that we can sell against these LEAP options. So if you indeed only had a $50,000 portfolio, you could only sell one cash secured put for $50,000. But with a LEAP option, you can buy so much more because with shares, it would cost you $57,000 for 100 shares. With this LEAP option, you're controlling 70 shares for $4,000. Now, I like to preach not to put any more than 10% of your portfolio into any one position or strategy. However, when you're doing something like this and you're doing it on the SPY and you have a $50,000 account, smaller accounts have a slightly higher risk tolerance. If you had a $500,000 account, you'd want to keep less than 10% in this position, maybe 5%. On a $50,000 account, you could realistically put $10,000 into this strategy, maybe $20,000 if you really want to jump forward and make some extra money. That's risky. $20,000 is like 35%. Or actually, it's more like 40% of your portfolio. That's really risky. I would say 15,000 would be good because that's about 30%. You can get away with that if you must, but let's just do 3 LEAP options for a $50,000 portfolio. We're going to buy the 560. Now, you might get filled on this for around $44.50. So we'll buy 3 of these. This will give us a $13,350 cost. Now, we'll just round it down to 13,000 to keep it at a flat number. It makes it a lot easier. So let's go ahead, refresh this. And now that we've purchased those LEAP options, we can sell covered calls against them. And these covered calls are going to help finance the cost of the LEAP options. And over the course of 6 months, it'll get to a point where the LEAP options were near free or completely free and maybe free plus even extra profits on top. So when you sell them, all of that money is potential profits. Let me explain. We have $560 strike price on these LEAP options. So we want to sell covered calls. Well, what we're going to want to do is we'll want to look at the SPY and figure out which call options would be safe to sell. We can see that the 10-day has dropped below the 20 and they both have dropped below the 100-day, and we're in a pullback hitting a pretty strong support of 575. We can see that it's bounced off 575 here and here. So it's likely that the S&P 500 won't fall below 576 or 575. In fact, it's looking like 577 is going to be a floor this coming week unless we have a major pullback during the elections. So be very wary of that. I'm not calling the SPY as a trade alert right now because the elections and the pullback, you ultimately want to buy these LEAP options when the stock is in the red, when it's pulling back. That is your go sign. That is your check mark. When the stock is pulling back just like this, you want to make sure to buy. When it pulls back again, you buy. Pulls back again. These are buying opportunities. When the stock makes a move, something like this right here, then you'd want to get out and sell your LEAP options at some point. But you want to do this long term and print consistent income. It's not like you have $100,000 or $200,000 on the table. It's only $13,000, which is not a lot of money. And this can grow your wealth exponentially because after you make money after a few months, you can start adding LEAP options. After 3 months of selling covered calls, you'll be able to roll these LEAP options out a few months longer and then add more and keep exponentially growing your wealth. Let's not get too carried away. Let's take a look at this. And I say that right now, this is just for the current situation. There's a lot of resistance at 584 and 585. So it's safe to say that 587 or 588, we're going to want to go safe for 588 or even 589. And we're going to sell these either daily or weekly. We can sell a few times a week. It's up to you. Ultimately, I like to do weekly on the SPY, and I'll show you both options. If I was going to sell weekly, I would do a 590. If I'm going to do daily, I am going to do maybe like a 585 or maybe a little bit lower. And I'll show you on the SPY right now. If we were to sell covered calls going daily, we're going to make about $32 to $50. If we sell the 582, it's a delta of 23. You want to try to stay around 20 to 25 delta, maybe 30, but 20 to 25 is a lot safer because you could get pinned on this and assigned if it goes into the money. But I'll explain what happens when you're pinned between your LEAP and your short call. Do not worry about this. It's not anything you need to worry about. I'll explain that in a minute. So you have the 560 call and you're going to sell a 582 short call for $52 or $53 premium. This is a 23 delta. It's perfectly safe. We're going to execute 3 of these because we have 3 LEAP options. So we're going to execute 3 of these. We're going to wait for the stock price to go up a little bit after it's pulled back and you bought your LEAP options. Wait for the stock to start coming up. This will increase in value, but roughly a 23 to 25 delta is going to get you around $50, maybe 60 depending on the day, but roughly it's around 50. So we'll just go with 52 because it's roughly what the daily rate would be on a 20 to 25 delta. And we have 3 of these. So we're going to generate about $156 per day. If we do this 5 days a week, it's going to generate $780 a week. We times this by 4, it's $3,120 a month. Now, this might not seem like a lot of money or profits, but it is actually a lot because 10% of 13,000 is 1,300. If we double that, it's 2,600. This is like a 22% per month return. And the reason we're able to squeeze that out is because we're using theta to our advantage. Theta and vega, implied volatility, and we're using gamma decay and delta decay. And we're using this because of the volatility, the theta decay, and because they're daily options. Because these options expire daily, there's much more theta and decay on delta and gamma, and the vega is a little bit crazier than it would be on a weekly option. And I'll show you in a second what I'm talking about. If you are selling weekly options, it will be slightly less. It's probably going to be more like 16% when you go weekly versus daily throughout the month. You make closer to 20 or 22%, and they're going to be the same safety. They're going to be 20 to 25 delta. So if you're doing this on 13,000, you will generate $3,000. So after doing this for 3 months, that's $9,000. You will get 2 more LEAP options because it's 9,000 in profits. Now you can buy 2 more LEAP options. So after 3 months, you now have 5 LEAP options. And then 5 of these contracts would be $260 per day. If we times $260 per day times 5 days, it's $1,300 a week times 4. This is $5,200 a month. We do this for 2 months, and now you have 2 more LEAP options, and now we're getting closer to $10,000 a month. And you've done this after only 6 months. 3 months, now you're at $5,200 a month. 3 more months, now you're getting to a point where you now have 7 LEAP options. And selling 7 of these is going to bring in $363 a day. 363 times 5, and then times 4. Monthly is $7,200. So with a $50,000 account, only utilizing 13,000 of that, which is just a little over 20% of your portfolio, which is fairly safe, especially because it's the SPY. Within 6 months, you're already printing $7,200 a month. Now, there are downsides, and we're going to get to those, but I'm going to show you what the weekly rate would be like on these options. So if we were doing this back with our original 3 options, and we're going to do this on the weekly rate, which is November 1st next week, we would want to sell something closer to 25 delta, which would be 587. maybe 586. This is $3 higher out of the money, or $4 higher out of the money than the previous strategy daily. However, because the fact that it expires 5 days from now, we have to go a little higher, which will give us a little bit of cushion on the top end. So this is a 27 delta. It's a little on the higher side. 587 is a 23. It's a lot safer. 140 times 3, it's going to be 420 a week. Now, when we are selling the daily options, 50 times 3 times 5, it's 750 versus 420. So realistically, it's almost double the money. To make this worth it, you'd have to sell a 585, which is a 30 delta. This, like I said, is $3 higher than the previous strategy that was at 582, which would have been down here daily. We can now come up to 585 going out the week. Honestly, I would say 586 is much safer. I really would not want to go below 586. With 3 of these, we're making 513, which is about $200 less. We do this by 4 weeks. 513 times 4. In our first month, we're still making $2,000. 10% of 13,000 is 1,300. So this is 15%. Just like I said, 15 to 16% if you go weekly, but you're going to get closer to 20 to 22% if you go daily. I like to stay active. I like to get in and out of trades. Every day, there's always something to trade and something to make money on. So it depends on your strategy. I prefer daily, but you can do weekly. Now, there are downsides, and we're going to address 2 of these downsides. Number 1, what happens if the stock runs through your call? Well, if you sell daily options, if you're selling a 582 call option right around here, and let's say you open the trade up when the stock is 580. And you collect $50. Well, the stock that day, midday to end of day, starts to go up and it hits 582, 583. It might at some point show you in the negative a lot. Like it's going to go from $50 value to maybe 130. Each of these options are going to show you $70, $80, $90 in the negative. So if the stock was to come up to say 583.22 and stay right there, and at noon, the option's probably going to be worth like 150, 160, which means you're going to be like $110 in the negative per contract. However, as the day goes on, this option will be worth less and less. It'll go from 170 or 180 to like 165, 162, 155, 145. As the day goes on, if the stock stays at 583.22, then it's going to keep going down. And eventually, as you get closer to 4 o'clock, this option will be worth its intrinsic value. It's in the money value. So the stock price is 583.22. Then the option is going to be worth 122 because 583.22 minus 582 is 122, $122. And because you collected $50, you're only buying it back for a $72 loss. So it might look like you're really in the red as the stock's going up intraday, but as you get near the end of the day, it's only worth its intrinsic value. The stock could also dump closer to the strike price, let's say 582.12, and you'll end up being able to buy this back for $12 loss and then just sell the next day to 585. You'll be able to do this a lot. If it's not a huge loss, I'll just buy them back at a loss and I'll recoup that after 2 to 3 days of trading, sometimes in 1 or 2 days, depending on where the stock goes. If you're wondering what happens if the stock skyrockets on your 582 and goes to like 588 or 590 and you get assigned, well, this is not the worst case scenario, but it's not great. So if you get assigned at $588, you're only going to collect what you have as a strike price, which in this case is $582. So you're going to collect $58,200. If you get assigned on your short call and then you have to exercise your long leap call to cover the shares you don't have to acquire them. This way you can send them to the buyer who purchased you and assigned you in your short call. Yes, that can happen. And it's not good because you'll lose a little bit of money on the leap typically. So in order to avoid that, you buy your short call back at a loss, which I just explained. You buy it back at a loss and you sell covered calls going forward to recoup your money. And since you have a $50,000 portfolio, you don't really have to worry about losing 3 contracts at 70 bucks, $210 loss today. Well, tomorrow is going to be another day at $156. Remember, that's what we're making, $50 a day, roughly $52 a day, $154, $156 a day, depending on the premium. So if we lose $210 today, tomorrow makes up for most of it. The next day we're back in the green again. So that's not a problem. Even if we were to lose a little bit more on these options, say $100 per option, it's $300 loss. 2 days, we make that back. Either way, realistically, on this strategy, within 2 to 3 days, you're back in the green again. However, what happens if you don't have the capital or don't want to take that kind of a loss? Here's the safe thing about running this strategy. Your LEAP option, your long, deep in the money call option that you bought that was 6 months out, moves in tandem with your short call. So when you sell a 582, even though that goes deep in the red as the price goes up, let's say the ETF goes to 590, well then this call option, the short one you sold, the short call, is worth the intrinsic value at expiration of $800. So at 3:45 p.m., it would cost you $800 to buy that back. So if you buy it back at an $800 loss, that's fine because your LEAP option has appreciated in value by around $800. So really you're at break even. They work in tandem. Now, you could lose a little bit on the short-term volatility of the short call, but typically, since this is a daily option that you're trading on the short call and that you're selling, it's not going to be worth much at 345. So this is the ultimate strategy. You wait until 345 to 350 and you buy back the short at its intrinsic value loss and you sell the LEAP at its gain. It will cover most, if not all, of the losses as they work in tandem. And this is the ultimate safe play because of that. Ultimately, I don't think that this would happen because it's never happened to me before where the ETF has moved $8 in a day and got me very deep in the red on call options that I couldn't just roll out. Because realistically, you could just roll these call options out or you could just buy them back at a loss. Even at an $800 loss, that's, $800 per LEAP option. You're getting 50 per day. So going forward, you're still going to make 250 a week. At the end of the month, it's 1,000. Within 3 to 3.5 weeks, you've made all that loss back anyway. And typically when I go to the end of the year and look at my profits from running this strategy, it's usually somewhere between 70 and 200% per year, depending on what goes on, but it's usually double your money. So if you have a $50,000 account, you can turn it into $100K within a year very easily. In fact, I am a slightly more aggressive trader with LEAP options, and I typically can gain 200 or 300% per year because we're at 22% per month doing it with the daily trades. 22 times 12 is 264, and maybe you'll have 1 or 2 bad months out of the year. So 200% per year. If you have a $50,000 portfolio, you can turn that into 150 realistically. I'd say up between 100 and 150 is going to be quite easy, especially on the SPY. So now let's talk about what do we do with this LEAP option after we've made money? Well, when we get closer to the 6-month mark, before we have the theta curve, which really starts eating away at this option, we want to sell it for profits. This typically happens 30 to 45 days prior to expiration. As we get into the last 30 days, it really starts chipping away at the value, the extrinsic time value of this LEAP option. So what I typically do is when we get to month 5, I either sell those LEAP options after my final short calls that I've sold against it expire worthless. I then start looking to exit at a profit on the LEAP options. However, you can also roll those LEAP options out 6 more months, or you could just sell them for profit and buy new ones. But typically what I do is when I have LEAP options, I will just roll them to go even further out in time. So let me show you real simply what typically happens in a 6-month window, starting out with 3 contracts at $13,000 on a $50,000 account. So like I showed you, we had a $50 premium per day. So we do $50 premium per day. And even if the stock goes up, our strike price on the short call will now go up because we're going by delta. And as long as we keep raising our price with the stock and we stay between 20 and 25 delta, we will have a $50 premium roughly. So let's just say, I think it was 52 just to be safe. I think it was, yeah, 52. So let's just say $52 times 3 times 5 is $780 per week. We do this per month. It's $31.20 per month. Let me open up my whiteboard. So on the SPY, $31.20 in the first month and the second month and the third month. So 3 months. We times this by 3, $93.60. So we have $93.60. Now, if we divide that by 2, we can buy 2 more LEAP options and still have some money to spare because they were $4,400. But let's just say they cost $4,600. Because later on, by the end of the year, there'll be several thousand extra dollars left over, and we use that to compensate for any losses. So what I mean by that is these options, these LEAP options are $4,400. That's what we paid for them. If we divide this profit, we can buy 2 LEAP options and have $280 per LEAP option left over, because if we take away the LEAP option of $4,400, we're left with about $280. So $500 after 3 months will just be sitting there. And after 6 months, there'll be $1,000, because these LEAP options, we're going by 70 delta. 70 delta is going to be roughly around $4,400 to $4,500. So we're just going to consider that gone. It covers losses. We could have extra money left over, but that'll cover some losses for a few days here and there. So now we have $93.60. We now have 5 LEAP options. So we can do 52 times 5. So after the third month, we're now making $260 a day. Times this by 5 is $1,300. Times this by 4 is $5,200. So we can do $5,200. This is the 3 months. And this will be up to 6 months, which is $5,200 times 3, giving us $15,600. So you guys can see in 6 months, we've generated another $15,000. We are looking to get out of this position actually in month 5 if we're going to sell the LEAP options, or we're going to have to roll these out and keep going. But what would we have made in this 6-month window? We would make $93.60. We would make $15,600, which is $24,960. And because the stock price of the ETF has likely went up from 577 to probably 582, 585. There's realistically, there could be 700 to 1,000 per LEAP option, or maybe more. That's probably very conservative. But let's say SPY just went from 580 to 581 and it just consolidated a lot, and you're making a lot of money on the short calls. So looking at the SPY only going up $4 in 6 months is extreme conservative approach. Like, there's just no way that it's going to be that little. And if it was, we're looking at about $700 per contract or more. So we could be looking at another $2,100 to $2,500. So we do that. We've made $27,460 on 13,000. We have turned 13,000 into 41, which is a lot. This is a 3x return. 3x return in 6 months. Do this twice. 6 times 2 is 12 months. We are looking at making profits of a lot more, because we can now, with this $27,000, we can divide that by 4,500. We can buy 6 LEAP options plus the original 3, which is 9. So after the 6-month mark, we're realistically making roughly $468 per day times 5 days, $23.40 a week times 4 weeks. We're making pretty close to $10,000 a month after 6 months. And that's only using $13,000 of your $50,000 account. We didn't use a big, huge portion of your $50,000 account. We played it safe. We kept it to around 20%, which is a little on the slightly risky side, but it's the S&P 500. And still, even accounting for some losses along the way, within 6 to 8 months, you'll be somewhere between $8,000 to $10,000 a month. If you have a $100,000 account, well, then you can do a lot more than 13,000. You could do more like 20,000, or you could do 25,000. So you'll be looking more or less at starting out with 5 contracts. So right there, you're looking at $250 a day, which is a lot. That's $1,250 a week. That's $5K a month. On a $100,000 account, you could be doing $5K a month easy. Easy. That is like literally like 18% of your portfolio. If you got a little bit more aggressive and say bought 10 of these LEAPs for 40,000, which was half your account, then you'll be doing like 500 a day, which is 2,500 a week. That's $10,000 a month, only utilizing 40,000. So you can see how very powerful this strategy is, even while implementing it super safely at 15 to 20% of your portfolio size. You can still, on 13,000 on a $50,000 account, turn that into a 3x return return in 6 months and start off on your 7th and 8th month working at $9,000 to $10,000 a month on a $50,000 account while only utilizing $13,000 worth of capital. If you guys are looking to learn even more than just this strategy, and maybe you're confused by it, or you're looking to just grow your portfolio and you're looking for mentorship, I would love to help you. You guys can sign up at investwithcorey.com. Links in the information box below. I would love to help you, fam. I offer a full training course filled with so many strategies just like this, dozens and dozens, over 5 hours of this content, as well as a full Discord and one-on-one coaching with me so that I can help you grow your portfolio. I look forward to seeing you guys on the next video. Thanks so much. We'll see you soon.